Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with the man, the myth, the legend, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Hey, man, nice to see you as well. One of the things I wanted to talk about with you, because you've always told us, you've told us this a year ago, probably a year and a half ago. It's better to get out at the top than, or better to know the top than the bottom. A lot of people are realizing just how accurate that statement is in the environment we are today. But I wanted to talk about two. I don't know if it's an investing strategy or a marketing thing that just drive me bananas. And that is either Diamond Hands or HODL. Both of those things scream retail investors. They scream rookie. They scream pain. What do you think of those two, I don't know, strategies?
So it's a narrative, of people in the crypto space, the meme stocks, things like that, because, the theory is, and their thinking is, if we all buy and hold, price goes up, but what they're not understanding is, in order for price to go up, you got to sell at higher prices. So if you hold on forever and you never sell, prices can't keep going up. It's got to trade. The other thing is prices don't keep going up forever. And there's a narrative and a theme in the crypto space that prices are just going to go one direction only. They're always going to go up. Now, to the credit of that, space and the assets, that's kind of what they've done, but so have all assets, real estate, everything, but they all have their peaks and valleys. And, the problem with that thinking is, and there's a lot of people, a lot of very successful investors in different spaces that never sell anything. That was, I know a lot of people in real estate, that's been their philosophy, buy and never sell, but usually those are people that got in a long, long time ago, very low. Right. Same thing with crypto. A lot of the people that got into Bitcoin at, sub $1, sub $100, sub, $10,000, that can serve them well for a while. But a lot of people, unfortunately, got in the last year at the top. They got in, the first peak in the 60s, and they got in at the second peak in the 60s. And, if you got in there, there's no guarantee that we'll ever get back to those levels again and beyond. I'm not saying we won't. I'm not saying we can't. I'm saying there's no guarantee. And there's no guarantee that if you do, it's going to stay there. So that's where that narrative comes from. There's a lot of tribalism in the crypto space, with different assets, versus what they really need is a positive network effect. They need, people like me, like you, like the average, boomer out there that has a nice big, retirement cushion to invest. No, that's what the space needs. There's 30, $40 trillion worth of investable assets out there that can be brought into the space. But what that individual is looking for, my peers that ask me questions about crypto that won't go near it. Number one, regulation. They want regulation and clarity. Number two, they want stability. They want to know that it's going to go up. It doesn't have to go up 100%, give me 10% a year. They'd be happy with that. And they would be more comfortable with it versus these huge peaks and valleys. And unfortunately, there is, a narrative and a group within a lot of the crypto spaces that, that alienate those people and, lambaste those people and criticize, older generation, which is really unwise. I mean, it's just really silly. If you're trying to grow your space and you're trying to grow the value of your asset, wwhy would you want to alienate anybody? You would want to bring in as many, right? But it's, in addition to HODL and Diamond Hands and Laser Eyes, then you have, they criticize newbies instead of trying to help them. They just, criticize them, and they, it's just really silly how standoffish some of the space is. But back to the whole mentality of HODL. So, at the end of the day, you want to buy low and sell high. The most successful investors of all time, that's what they do. Nobody holds everything forever. Warren Buffett rebalances and sells all the time. Carl Icahn, Sam Zell, real estate. I mean, he's exited his entire real estate portfolio. He got in, wrote it up, exited at the right time. Companies, everybody exits. That's the thing that people forget. Everybody exits sooner or later. So you want to exit when you can get what you want, versus when you have to and getting whatever you could get. And that's what I've told people. I've heard it my entire career in real estate and stocks and everything else. A lot of people just think, oh, it's just going to keep going up forever. And as we know, bad times never last and good times never last. It's all peaks and valleys. Markets don't go up forever. A lot of people are going to get hurt in real estate too, because this is a trickle down. What we're seeing in markets now is going to hit the real estate sector because rates are going up. As treasuries go up with the flight to safety, interest rates go up in the housing market. And what do people do? They buy payments. So you're going to see, all of the valuations in real estate, that we've gained over the last couple of years, will get wiped out pretty much instantly overnight if rates go up 1-2%.
Yeah, we're going to talk about that in episode number 3.
Values. I'm not saying the market's going to change or switch. I'm just saying the value of what somebody can afford is going to change as those rates go up.
Totally agree. It's all about payment affordability. Absolutely correct. We're going to talk about real estate next. So that's really what I'm looking at as a consumer, because they're my biggest competitor. But back to HODL and Diamond Hands, or laser eyes. One of the biggest eye-opening moments for me in college, because I have an econ degree, was the introduction of something called an opportunity cost. Opportunity cost is, for most people, not well understood. It is not considered. It doesn't show up on a balance sheet or an income statement, but it is one of the greatest considerations that people frankly ignore. So let's talk about the opportunity cost of being a HODL or a diamond hand, because it's gigantic and people don't appreciate it.
Yeah, it can. And, the idea of opportunity cost is, future value, right? So, what can a dollar do for you, right now today versus, what can it do for you 10 years from now? And then compounding. So for me, it's always been, how can I earn the most amount of money in a business and an investment, whatever, with the least amount of time, energy, and effort possible? So I want to compound cash. I want to build cash. And you do that through buying and selling. You buy low, sell high, and then you just grow, and you repeat. So there's an opportunity cost, not only in your assets, but in your money and in your time. And as we all know, money is energy, money is time. So, even when you just look at, let's say, an asset goes up 100% in a year, okay, and it has 20% fluctuations throughout the year, about 8 or 10 times. Well, if you're buying, selling, well, you're going to end up with 200 or 300% return versus 100. Now, that takes work. It takes time, energy, and effort. So, again, the HODL mentality can work if you have a very low basis and you're looking at long-term appreciation, but when you're getting in at the peak, which we are at the peak in all assets, when you're getting in now, that could work, but it may be 20 or 30 or 50 or 100 years from now. You just don't know. Yeah. So, that opportunity cost, when you're maxing out right now today, you're losing the opportunity to take advantage of buying dips and, recirculating that capital and recycling that capital. And, again, it's just been proven throughout history. You buy low, you sell high, and you keep compounding and growing your account.
Yeah. I just wanted to give 3, I don't know if it's going to be 3, but a couple of real world examples in my life where HODL would have destroyed me. So people who follow my channel, read my book, know that I was heavily invested in tech stocks back in the 2000s. It worked until it didn't. At the end, I went to cash. I ended up, having about $40,000. That $40,000 was seed capital to what became one rental at a time. I could have held those tech stocks and they would have eventually gotten back. It took 18 years or 17 years. So I could have broke even after 17 years, or I could have gotten out and started doing what I did for real estate. So again, it's the opportunity cost is real. I mean, well, the problem is when markets correct, you don't know how long that's going to take. And look at real estate. So let's just use real estate. We're both in real estate. 2008 and 9, it took 10 years to get back to the levels that we were at, before that, decline started happening. And, here we are. What is this now? 13 years later, we finally are starting to see appreciation over the last 2 or 3 years. And that's only because of what happened in the pandemic and the, quantitative easing by the Fed. Again, liquidity thrown into the market, really, really record low interest rates. That's the only reason values hit where they hit. So anybody who bought at the top 2008 and 9, in some markets, every market's different. There's pockets, but in general, average houses lost, it took 8 to 10 years for that market to come back. And that's real estate cycles. They run in that 14, 15 year cycle. Yeah, that was going to be my second example, because one of the things I did, because again, I'm a buy and hold guy, right? I'm that person who buys with the intention to hold forever. But I bought a property, Norris Drive, first one I ever bought, written about in my book. We sold it in 2006 for $264. It ran to 300 over the next, 9 or 10 months, and then crashed all the way to 75 grand. Again, if I would have had the HODL strategy or Diamond Hands, I'd still be working. I would not be talking to you today. I'd be on some airplane in some country selling some software. Again, it was a peak. Again, to your point, it's better to get out at the peak than try to call the bottom. It was unaffordable. I did my numbers. I was like, okay, I sold all my houses. and they became apartments, and apartments became what was the seed to get going. So again, I think,
well, look at Grant
crazy.
Cardone. We talked about Grant Cardone last week, and
Yeah.
he sold his house, and I can't remember where it was, somewhere in LA County. I don't know if it was Malibu or where it was. His first house that he sold for whatever it was.
Lionel Richie's house. That's all I remember.
Yeah, and he it might have been Hollywood or somewhere. I don't know.
Yeah.
Anyways, he took took that money and then used it to invest in commercial real estate. And he said the guy that bought the house from him was giving him a hard time, saying, "Dude, this thing's worth twice as much as you sold it to me for." And he said, but yeah, look at what it did for me. I took that. Now I've got $4 billion worth of real estate that has, maybe, $300-400 million in equity, whatever it is, a couple $100 million in equity plus cash flow. If I'd have held on to that house to double it, I mean, I would have lost $100 million.
Yeah. Hundreds of millions of dollars.
Hundreds of millions of dollars. So what people don't understand that when they're looking at the HODL and the Diamond Hands, and what they're looking at is, let's buy AMC stock and, just hang on to this thing and, maybe double or triple our money after 10 years. And look at what happened now. I mean, they're stuck in that AMC stock. They're stuck in that GME GameStop, stock. And people jumped into that at $400 and said, I'm just going to hold on forever. It may never, ever get back.
And if it ever does, it'll be decades from now. It'll be a different company by then. So yeah, I agree with you. Right. But two examples I gave you. One is I sucked up a loss of 6 figures, went to cash, licked my wounds, realized I was a speculator. Then I did my work and entered real estate. The other one is I was a buy and hold investor. I had no intentions to sell, but I knew it was unaffordable and I could not buy. So I became a seller. And again, sometimes when the market does something, you've got to pay attention. I think Diamond Hands and HODL are some of the worst investing advice ever. And I've given you 2 personal examples.
Yeah, especially right now. You just, those things just don't work in this day and age because the markets move so fast, and it's so much reliant on the Fed. And again, and other factors. I mean, we have, the Russia-Ukraine situation that could weigh on the markets depending on what happens there. You still have the pandemic we're dealing with, and we saw that popped up, and look what happened. There's just so many things that can happen now. And again, you never know when you need to exit. And we will all exit. We all liquidate, every single one of us. And if it's not us, it's passed down, and they have to liquidate for future generations. So everybody exit, everybody liquidates. You ain't getting out of here alive. No. So the key is you want to make those decisions of exiting when you can to maximize that versus when you have to and getting whatever you can get. And I've seen it over and over and over where people, again, I'll use some examples of real estate. When I was buying real estate, back in, 2008, 2009, when the market was changing and values were dipping and people still wanted, peak prices, in 2010 or 11, I said, look, the market's changed. The values are down. I can't pay you that. I can give you this. It'll be worth twice as much in 10 years. And, it wasn't. It got back to where, in 10 years, it just took that long to stabilize and get back to what they paid for it in 08, 09. Yeah. So now they might be up a little bit, but 20 or 30% after, 10 years or 12 years.
Yeah, it's crazy.
Now, Bitcoin and crypto is different because those things have been through the roof. And even now they've lost, a ton of value, but they're still up. And they're still insanely up over where they were even a year ago. Yeah. Where are we at now, January, from March? I don't know, about a year ago. I'd have to look at the charts, but going back
15 minutes. I mean, I bought in November of 19 at 20,000 or 19,000 or something. So yeah. So you're still up. So it's hard for people that are in at that basis to think otherwise because it's worked for them. Yeah. This is a lot of fun. I just had to get this off my chest. I see more and more people that are down and down big, screaming Diamond Hands. When if I would have been a Diamond Hand, I would not be talking to you today. It's sometimes you just got to learn your lesson, and you made a mistake. You gambled, you speculated. That's the big thing. If you are a speculator, own it, but don't call yourself an investor, which is what I did, and be a speculator. That is a mismatch. And when the market goes against you, you will be smashed. And that's just,
and buy the dip. And the other thing too is the buy the dip. So that's, Diamond Hands, HODL, buy the dip. And, buy the dip's great on the way up in a bull market in a, super cycle like we've been in. Buy the dip on the way down. You buy the dip, you can become the dip. Look at AMC, look at GameStop. If you bought the dip from 400 down, you are the dip, it may never come back. Now, crypto does this. So it's a different animal, but there's no guarantees. And we'll see how it all shakes back. I mean, I know it'll come back to a degree, but how far will it go and where will it come back? Nobody knows. So
Yeah.
we just have to wait and see. And again, a lot of it depends on the Fed. A lot of it depends on, where we're headed and, what the future economic climate looks like. And a lot of uncertainty out there right now.
Very cool, Greg. Well, folks, got to follow you. You put a lot of amazing stuff. You're helping people around the world. I'm actually interviewing one of your students on Sunday, I think. So that should be a lot of fun. So Greg, how can people find you?
Yeah, gregdickerson.com. All my info's there. YouTube channel, podcast, gregdickerson.com.
Thanks, buddy.